Welcome back, everyone. Until this point, we have got all the historic data for balance sheet, income statement, cash flow statement, and we have also forecasted the relevant line items for valuation of this company. In this file or in this video, we are going to start with the valuation inputs. And from this video onwards, we are going to talk about valuation of this company. To complete this video or extract the valuation input, first of all, we are going to save this file. The name of the file will be 21.finmod Britannia valuation inputs. Now, in this file, before we proceed, we want to enter rows in such a way that row number 18, which is input T, comes to row number 30. So I select from 18 everything up to row number 31, and I just use Control plus. And the moment I use Control plus, we have multiple rows added here where the input T row has come to 32. So actually, I want this to row number 30. So I'm deleting these two rows, and here we have input timelines in row number 30. We come to row number 17 and select B17 and C17 and change the cell style to heading 3. I hard code this as valuation inputs. I come to the cell which is C18 and I write valuation date. I come to this cell which is E18 and I give an optional input and date. And we are going to give 01 Feb 2026. I write stub. Right now we are leaving this as blank. Then we talk about risk-free rate. We come to this, we just give an input cell style. Then we have credit risk premium. Then we have historical beta. So this is using daily returns. Equity risk premium terminal growth rate terminal year EV enterprise value divided by EBITDA current market price number of outstanding shares market value of equity. Now this is where we come to cell number E21 up to the terminal growth. Everything is going to be input cell style. We leave this as a blank. We'll discuss this about later, and we select this three and everything is going to be input. Now let's address each and every of them. For risk-free rate, what we would be using. So let me just write what we would be doing and how you would be using this file and this information if you're preparing the similar kind of model for some other company. For this, we are going to refer to the current 10-year government bond yield. What could be the source? CCIL could be one of the source or Bloomberg. So Clearing Corporation of India Limited or Bloomberg can be the source. Let me show you. If you look at this particular website, this is of Bloomberg's. When we look at Asia Pacific 10-year government bonds, what do we find within India? The yields is coming out to be 6.87. So let's take this as 6.87% to its face value. I come back here, I just hard code 6.87%, and I would encourage actually to encourage you to add a comment here. So just take a new comment and give what your source are and get that link as well from where you are getting that data source. And remember that 10-year government yield are going to change on a regular basis. So make sure give the date on which you are extracting that information. Changing the cell style to percentage in this case. So this is 6.87. Get talking about the credit risk premium, we are going to refer to as YTM for the bonds issued by the company because that is a proxy of what will be the cost of finance to the company if they are going to raise bonds, raise debt from public. If that is not available, one other way could be looking at similar rated company within the industry and assuming that similar rated company is or has already a bond issued in the public and using that YTM as a proxy for your company. So let me show you what we are going to see. When we look at the CRISIL rating for the Britannia Industries, we find that the ratings has been CRISIL triple A or stable. We can say this. So there was a long-term rating done by the CRISIL for this Britannia Industry somewhere in October 8, 2025. When we look at similarly rated rational for Dabur, which was somewhere around November 20, 2025, which is on the similar timelines, this also has like triple A stable kind of rated. Now, these both of these companies are in FMCG and these both are rated AAA. Now, when I used a third party resource and there is a bonds placed by Dabur, which is privately issued. And when we look at its YTM, it is 7.55%. So 7.55% could be used as a proxy for cost of debt for the company, right? Now, this is what the total cost of debt is going to be 7.55%. Now, this 7.55% will also include something which is called as risk-free rate as well. So, what is the remaining interest rate which we can see? So, the remaining interest rate is basically the credit risk premium. So the credit risk premium is what has been left out in this case. So in this case, we are going to refer to as 7.55% minus whatever the risk-free rate has been and changing this sell style to Britannia. And this is what we have as credit risk premium. So again, I would encourage you to give a comment in this case. So let me just write it in this case. So Dabur's privately placed bonds has a rating of has a YTM of 7.55%. And of course, you can give a more detailed version where you can also say that these both are similarly, Britannia and Dabur are similarly rated. So this is what we have, which is for credit risk premium. Next is historical beta, which is daily returns. In this case, for this, we would be requiring historical data. From where we are going to get this data, let me show you. Actually, you can go to this NSC websites and you can look out for report daily historical you can look at the historical data for the security wise archives where you are going to find this in the home page. You go to resources, you are going to find something within this historical report security wise price volume archives, and the moment you search this is what you get. Now you can just hard code Britannia and we get this Britannia. You can select EQ. You can customize the time frame, 5 year, 1 year, whatever the time frame is there for which you want to download the data. And then, of course, you can just give this a go kind of a thing and download this as CSV file. Once you have this CSV file, you can again sort them because it will have multiple columns. As you can see here, it will have date, previous close, open, everything. What we will require is basically the closing price. Similarly, when we go to this resources, we will also have this historical index data. Why we require historical index data is because if we want to calculate beta, we will require the historical daily returns for the index, which in our case would be Nifty 50, and daily returns for Britannia as well. So here we are going to select this as Nifty 50, and again you can customize it and you can get the historical data. Now, for the ease of our discussion, I already have this everything sorted for us. So this is what we have the data. So let me just copy this particular segment in our new file. Let me get this data in our valuation model. All right. What we have done is basically we have got all the historical data for the last 2 years for Nifty 50 and Britannia on a daily basis. Now, what we need to calculate actually the beta, right? And for the beta, what we are going to do, I'm deleting this part. For beta, what we are going to do, we are going to calculate daily returns for both of these securities, which is Nifty 50 and Britannia. So let me just give this as a header, Nifty 50, or let me write daily returns for Nifty 50. And this is going to be daily returns for Britannia. And let me just increase the width of the columns. And here we have. Let me also freeze this to freeze all WFF. And here we have everything freezed. Of course, I cannot calculate the daily return for first Feb 24 because I don't have the previous day's closing price for any of the securities. So we are going to start from the second cell, which is cell number D3 in this case. So this is going to be B3, which is second Feb closing price divided by first Feb closing price minus 1, changing the cell style to percentage, and here we have. And I copy this right, and just for the sake, we are going to modify this to two decimal places. Let me change this to 2 in percentage so that we have something to look at the daily returns, and I just copy this to all the remaining rows. Here we have the daily returns, and now we are going to calculate beta, directly the beta. Now to calculate the beta, we are going to use a function which is called as slope. So in slope, we are going to talk about known y's and known x. In this case, the x is independent, which is Nifty 50. Y is which is dependent, which is Britannia. So known y is going to be the array for daily returns of Britannia, which is selecting E3 to E496, comma. What is known X? For known X, which is independent, is always going to be the Nifty 50 or the index return. So D3 to D496. I close this and I press this enter. Change this in number to two decimal places. Change this with a heading 4 cell style. And this is what we have as beta for us using the historical daily price. So I copy this, I come to input and calculation, and I paste special as link. So here we have the daily returns of the beta. So let me just write it. This comes from historical data. Now let's talk about equity risk premium. And for equity risk premium, we would be referring to the CAPM model, which is RF plus beta and the difference between RM minus RF. For that, we require return of the market. And for that, we would be using ex post analysis, which is historical return of the Nifty 50. Let me show you where we can get that. Now for that, we are going to look at the PDF, which is fact sheet of Nifty 50. And this is where you can come from. You can go to about indices, and within indices, you will find Nifty 50 and broad market indices, and this is what you will have. Now, when you look at the statistics of this fact sheet, and of course, this is updated every 6 months. So we are going to find something called as the statistics price return total return. So I would suggest that we would be referring a since inception total return of the market. So that's what likely we are thinking is also going to be maintained, the total return, which is 12.38%. So in this CAPM model, which says RF plus beta and the difference between RM minus RF, the RM is going to be 12.38%. So let's come back. Equity risk premium, this is going to be 12.38% minus risk-free rate. And here we have equity risk premium. And of course, this will be in percentage, which is 5.5%. Of course, there are different other ways to also to measure the equity risk premium. This is one of the ways how you can look out into this. For terminal growth rate, we would be talking about this later while we are actually doing the valuation beyond 2031. And for looking at the current market price, we are going to refer to the closing price of Britannia of 30th Jan, which is 5860.5. So I'm using this 5860.50. For number of outstanding shares, this is going to come from annual report. So refer to annual report of the company. You need to go to notes for share capital, share capital, which is mentioned in balance sheet. I already have a number. I already have a number. And again, remember, we are going to convert this in crores. 240868296 divided by 1 crore. So this is what we have, number of outstanding shares, and market value is going to be outstanding shares multiplied by the current market price. And this is what we have as market value of the company. Now, this marks the completion of the valuation input broadly. And in the next video, we are going to start working with the discount rate for the valuation, which is basically the WACC for us. I hope you are clear with with this video and the concepts. If you have any question, drop that in comment box. Thank you for watching.